Very good afternoon, everyone. Welcome to today's uLaw webinar. The topic for today's webinar is Trust and General Reconciliation Demystified. Today's webinar has been accredited for 1 hour of professionalism CPD credits in the provinces of Ontario, New Brunswick, and British Columbia. Once again, I repeat, today's webinar on Trust and General Reconciliation Demystified is accredited for 1 hour of professionalism CPD credits in the provinces of Ontario, British Columbia, and New Brunswick. It is being recorded and will be available to you in our YouTube channel as early as Monday. Please do use the chat window to ask any questions that you may have during this webinar pertaining to the webinar, so that's in context. Like every other uLaw webinar, today's webinar has a specific agenda. We're going to talk about the reconciliation process, one of the important steps in legal firms' tasks as part of their weekly, monthly agenda to accomplish, and really talk about what is this process, and then further subdivide it into the aspects of the trust reconciliation as well as general reconciliation as it best pertains to your business. So if you do have a trust account, it's important that you generate this trust reconciliation reports. If you do not have a trust account, of course, you do not need a trust reconciliation report. Everyone has an operating account when you're running a law firm, so most definitely the general reconciliation is a must-have. And then we talk about what does audit readiness look like. And we'll cover about the important documents that you would have to generate as part of your business at least once a month to be on top of the numbers and all of the important documents that are specifically required during an audit process. Okay, so by being proactive of generating these documents ahead of time, keeping them chronologically generated and arranged on a monthly periodic basis, how best you can better prepare yourself to be audit ready from day one. Okay, and of course we'll look at the core aspects of that audit readiness and the financial management processes, and spend the last 10 to 15 minutes using uLaw as an example of legal accounting system and walk you through a simple demonstration of how you should consider generating these documents and what the outcome of such reconciliation documents and the audit readiness checklist looks like. Okay? And we've done this in many of our webinars in the past as well, and we continue to talk about the evolving legal tech, especially around accounting, especially around practice management. And if we take our attention back to maybe even 20, 30 years back, it was still a very heavily manual double entry or a one-write system that was pretty much used in law firms, maybe rarely used even today, but certainly you can see the advent of technology helping us move away from that to a more general accounting spreadsheet software, and now further evolved to build solutions that are specifically built to handle really the legal accounting aspects of the requirements, especially in a country such as Canada where audit readiness is important. And the evolution of not only the systems, but the evolution of technology has helped automate many of these important tasks that are otherwise required to be done on a manual basis. So if you really look at a spreadsheet software, of course it's a very inexpensive system. It allows you to document right away in an electronic format instead of having to write it down in a notebook. It certainly is a great next step. But in terms of formulas, in terms of automation, in terms of generating reports and documents, there is certainly a manual intervention that is needed. And of course, it takes time, especially if there are various number of transactions. Categorizing them can be a bit of a hassle. And the next evolution from that spreadsheet software comes the general accounting software. But if you are dealing with trust accounts, then it was not purpose-built for that. And then comes your legal accounting software that was purpose-built for law firms that can help you manage transactions, financial transactions, leading itself to the reconciliation process for both trust and for your general accounts. Okay, so we'll really cut to the chase to talk about this reconciliation process. So in general, as a law firm, you're going to notice that you have many different transactions that you need to be on top of, you need to be able to record and relay in terms of documents. Now, these could be day-to-day activities. This could be client-related activities. This could be your business office-related activities. Okay? But if there is a certain transaction that has a financial component or an association, then it's even more important that you record that transaction in a system or using some process that allows you to compare, contrast, and validate the transaction's existence between your system, where you're recording all of these transactions, against the bank or the financial institution that you are working with that pretty much also has another copy of these transactions as and when they occur. So if you were to think about it this way, let's say you're a law firm, you've just started off, you have a client that walks in, or based on your marketing efforts, you have a client who gives you a call, is willing to retain your service, and provides you an e-transfer for about $700 worth of a retainer after you've signed the retainer agreement. So signing the retainer agreement is certainly a transaction, but it's not yet a financial transaction. Accepting that $700 as funds into that bank, into your trust account, is of course a very important financial transaction that needs to be recorded and be available for you to further compare and contrast at the end of a specific logical time period. Whether that time period is at the end of the day, whether that time period is end of the week, or at least once a month, really comes down to your style, your busyness, your availability to do that task as when needed. So let's say you received that $700, and let's assume that's the only transaction that has happened in this month of November. Nothing else has happened. You've not docketed, you've not dispersed, you've not generated invoices, and you've not had any trust disbursements. That $700 is what's going to be the balance in your bank when you open up your bank account at the end of November. Now, the reconciliation process when it comes to the trust account is to say at the end of the month or that time period, compare your own books or your system and compare it with the information that's provided in the bank. And that's why, as part of a trust reconciliation process, the first step that the Law Society in its templatization of this document asks you to record the balance of the bank or the financial institution for that time period that you're ending this with. So if you've ended this on the 6th of November, then that's the date you put in. If this is the 28th or 26th of November, then you need to record the bank balance as of that date. So that's pretty much the first step in terms of comparing these two. Then the next step, of course, is understanding each and every transaction that you have recorded and has actually happened in that time period. So in this example of ours, let's assume $700 of money being deposited into your trust account is the only transaction that exists in both your own bookkeeping system as well as the bank. And if the bank balance is $700 and this is the only transaction, it's a very easy reconciliation process. So that particular month actually would be an easy breeze to do your reconciliation because it's the only transaction. It exists in both these places. Maybe the only thing you change is the actual date. Maybe you received the retainer on the 5th, but it only reflected on the 6th. So the dates may change between your bookkeeping system and the bank, and that's an important consideration to alter during that process. The third step really is understanding, as part of that transactional record keeping, is the anomalies that now may exist. So if it's a very straightforward process, you got the 700, that's all there exists, that's perfect. But let's say you've got 700 in your bookkeeping system, and then there's $1,000 in your trust balance as of, let's say, November 6th. So the bank or the financial system reflects an additional $300 to have been deposited into your trust account. When you reconcile, you're going to compare these two systems, and this is for your awareness and your ability now to compare and validate and now make any changes that you have to make before that reconciliation process is firmed up. So now is your opportunity when you see this to say, oops, there was that additional $300 retainer that I received from another client, and I may have failed to enter it into my own system. So that is what's called an outstanding deposit. A deposit that was meant to be reflected but has not been reflected in your system. So you would go and reflect it into your bookkeeping system, and now you should hopefully see two transactions, 700 for the first client and then 300 for the second client. The reverse of that is also true. It may so happen that you've got a retainer, you entered it into your bookkeeping system, and you may see $1,000 in your bookkeeping system, but only $700 being reflected in the bank, in which case you now have to appreciate and understand where could that anomaly be? Why is that there is that difference? So it may be a classic example where someone gave you a retainer check, mailed it to you. You right away did the due diligence of entering that information into your bookkeeping system, but for whatever reason, you failed to take that check and deposit it in the bank. So that's another reason why you would see a difference between the numbers reflected in your own system and the numbers reflected in the bank. Without boring you further, I'm just going to give you one last example of a practical, pragmatic situation where the numbers may vary, and that's what the Law Society wants you to capture in terms of outstanding checks and deposits. One, outstanding deposits, you failed to put the money in. The other situation is this. So let us say you had a trust disbursement. And this is, again, a rare case, happens mostly in the situation of a general account, but can always happen. You write a trust check as a disbursement for, let's say, a court fee or an application fee. Okay? Which means the money technically has been taken out in your bookkeeping system. You've recorded saying, all right, $200 have been taken or should have been taken on the 5th or 6th of November because I used it as a trust check for my application fee disbursement. Let's say for whatever reason that check was lost, it did not reach the end party who needs to withdraw the money. In the case of Ministry of Finance, Ministry of Attorney General, and let's assume they have not yet withdrawn that money. They've not yet cleared that check. They've not taken your check and put it into their bank account. Until they do that, that money is not going to be taken out of your trust account. That's a classic example of an outstanding withdrawal where you have reflected the money should have been taken out, but in real life, in the bank, that has not yet reflected. All of these factors need to be kept in mind as part of that reconciliation process for you to tell the story to your auditor when being asked about the transactions, the flow of money, and the reasons, if any, for difference between the numbers reflected in your system to the numbers that are actually being reflected in the bank as of a certain date when you're closing that month's reconciliation process. And the last component, which is step 4 that you see on the screen right here, is the final comparison of it. The step 3, which is very unique to only the trust reconciliation process, is a listing, what's called as a trust listing. So we spoke about the $1,000. The Law Society expects you to clearly indicate the actual name of the client, the file or the matter number, the last activity date, and the amount of trust balance as of that date. So if you notice, if there's $1,715.30 left in your trust account, where is that money? How is that money added up? Who has how much of money left in their trust balances? So you can clearly see for Peter Piper, you have $1,120. Susan has $72, and then Terry has $523.30. So this is a very important data component within a trust reconciliation report that you do need to reflect as part of that reconciliation document. Whether you do this manually, use any other system, be it legal accounting system or otherwise, unless the product already does it for you. If you're doing this yourself, very important to keep in mind that you have these 4 steps, or data points as we call it, recorded as part of that reconciliation process. Okay? So, one last wrapper or the summarization, comparing the financial transactions that have been recorded into your own bookkeeping system, whether that's paper, Excel sheet, legal accounting software, comparing that with the financial system and all of the record keeping that's happened in that, and finding ways to ensure that the transactions exist, and if they don't exist, validating through these outstanding deposits, outstanding checks, bank errors as possible practical issues that may cause the differences between these numbers, along with the listing of your outstanding client's trust listing, is everything that you need to take care of as part of that reconciliation process, the trust reconciliation process. Now, the general reconciliation process, very similar to trust. Now, the added aspect, of course, is in the case of trust reconciliations, you can be pretty sure that the transactions, or in fact, you should be very sure that these transactions have been reflected primarily for your clients. Retainer coming in, it's for a client. It's actually for a matter. Paying a disbursement for a specific file or a matter. So you're not going to be writing checks for office expenses from the trust account, for example. Whereas in the case of a general account, it's a little bit more involving. You not only may have transactions related to clients, you could potentially have transactions that are related to your own business. That is, keeping the lights on for your business, including office expenses. So as you reconcile your general account, you need to be, of course, prudent in looking at the transactions that makes most sense. The process of comparing these two systems remains to be the same. The process of recording any outstanding checks or deposits remains to be the same compared to the trust reconciliation. And the final comparison between what the bank's outstanding final balance is and your own bookkeeping system remains to be the same. The only difference, as you can clearly see, is we have one step lesser in the general reconciliation process, and that is you do not, of course, have a trust listing section in your general reconciliation. So I want to go back real quick. You can see here my step 3 within a trust reconciliation is outlining my trust listing, and in a general reconciliation process, you do not have that. So one immediate difference between these two documents. All right. Another important question that we want to cover is, how do you prepare for this reconciliation process? How often do you do it? And what pieces of information do you need to get started? So we believe, as part of going through the Law Society's recommendations, bookkeeping guidelines, and recommendations for audit readiness, there are 3 primarily important pieces of information that you need to get started with the reconciliation process. Number 1 is appreciating when you want to close this reconciliation document, or what is the date as of when you're generating that reconciliation process. There are certain law firms that do weekly reconciliations. There are certain law firms that do monthly reconciliations. The Law Society does recommend that at a minimum you do this once a month. Okay. So the date is probably the number 1 consideration to keep in mind, because everything is based on that date. 2 is having access to your financial institution's bank statement, whether that's print or electronic, for the end of that date. So if you're closing your books, the reconciliation is happening for the end of the month, let's say the 28th of October, then you of course need the bank statement. And today, of course, you have the electronic means. You can directly log in into your financial institution's online bank account, choose the end date as 28th of October, and you pretty much have that in a different window within your laptop or your computer, iPad, whatever it may be. There are law firms that use multiple screens, so it's easier for you to visually look at these 2 different systems, your own bookkeeping system and the bank. And that's something that we've seen that has really helped efficiencies in comparing it. Some law firms, of course, provide this or outsource this to third-party bookkeepers or accountants, and they have their own style of validating this. They would, of course, expect you to send them the bank statement for the reconciliation process. And the third aspect, and this is where the practicality of life affects this process the most. This is one area that can lead to the fear factor of not doing it, because sometimes people don't do it right away. They take several months before they catch up, and then the fear factor gets added up, saying, how am I going to deal with 6 months worth of data? I really don't know what the numbers were. And that's where you start to doubt and hope for that magic pill to make this go away, or have some individual do it for you automatically. And as much as that's wishful thinking, being prepared, starting ground up, knowing what's expected, and preparing yourself for success gives you a lot more, I would say, confidence and peace of mind. Even if you're outsourcing this to a third-party individual or company, knowing what's essential to be done gives you that confidence to even talk to your accountant, bookkeeper in a smart way. So with the third component is really where you're clearing the deposits and withdrawals one at a time. Especially if, a good example if you're a very busy real estate law firm that deals with real estate, you could have several, sometimes some of our clients have hundreds of transactions. And this is where each firm can differ in how they approach it. So you can either approach taking all those 100 transactions at the end of the month and dealing with it, or if you know that that is the pattern to expect for your law firm, you can be proactive and deal with just 20 or 25 transactions at the end of the week, which is a much lesser load on your plate. Clear that plate so that when the next set of transactions come in for the next week, you're very much prepared and you have lesser on your plate to deal with. And maybe you have 4 reconciliation documents in a month. The more the merrier. The recommendation is to have at least 1 a month. Okay, so if you have several hundred transactions, you of course have the authority and you have the power in your hand to have as multiple reconciliation documents. You can even have 10 reconciliation documents in a month. It's the efficiencies, it's your nature of business, it's how you go about ensuring that these steps are taken care of is what it comes down to. Of course, if you've ended the week, let's say November 6th, then when you do your next reconciliation, that date time period would be November 13th, for example, if you're doing it on a weekly basis. Okay? So with these 3 pieces of information that you do need, you are now ready to reconcile. All that's fine and dandy, but why do this anyways, right? Of course, it is a law society requirement, but beyond that mandate, which in many cases is the driving force for doing this to begin with, we believe there are some added advantages. If you can think about some value-added reasons for why you have to do this, maybe it helps you motivate to actually get it done beyond just the need for compliance. Okay. There are 1 or 2 good takeaways as a business owner if you do this reconciliation process on a regular basis. 1, as I mentioned, it gives you that confidence. It allows you to catch all the transactions that may be erroneous, not by your fault, but just the practicality of it. And you're in complete control over the pictures of the financial transactions that have entered and left your own business systems. So you have signed up as part of being a legal firm ownership, the trust and bank accounts, the general accounts. So who better than you to have full knowledge about the money coming in, leaving that, and knowing that they exist between your record keeping and the bank. A classic example that we often come across is that of a bank error. Now, there could be many reasons for a bank error. The common reasons when you first get started, of course, is if you have not clearly indicated that it's a trust account, the bank fees that you have to pay or the financial institution fees that you have to pay may be withdrawn out of your trust account. Now, that's a definite no. Typically what happens is at the time of reconciliation, you would catch that. You would see that the bank has $6 or $10 lesser than all of the transactions added up in your bookkeeping system because you never accounted for that bank error. If you've caught that early enough, you could maybe call the bank or approach the bank, ask them to take that deposit, that $10 back, and ensure that that money is taken out of your general account. Okay? If not, you have to now make sure that that reconciliation is being adjusted in the following week. Okay? So, of course, it allows you to catch. Okay, I believe there's someone who's looking to rejoin, so if you can kindly click on the link, we should be able to accept you in. Sorry about that. So, of course, it allows you to catch any mistakes or any errors that may have typically happened during that date time period. The second aspect is, now you're a busy legal firm, and as I mentioned earlier, there could be certain situations where you have forgotten to enter these important financial transactional details into your own system, into your own record-keeping system. Okay? This, of course, allows you to keep a tab on those possible mistakes. So we've heard a lot of stories where reconciliation processes have helped, where you've got checks in your drawers that you have not yet deposited. Or another classic example is, let's say there is a check that you've written to another party, and that check has not yet been cleared. The Law Society has certain guidelines for that as well. For example, if a check has not been cleared, then it's your responsibility to cancel that check. So for, let's say, over 6 months or a year, that particular transaction of the check has not yet been deposited or not yet been withdrawn, then it's your responsibility as a legal firm to call that party, tell them why aren't they able to deposit that check? Have they lost it? Or was it lost in mail? Putting a hold on that check, or rewriting another check so that it's automatically adjusted. We've seen that. It's important for you to keep a tab on those important financial transactions combined with the time period in which it has occurred. And that's why the date becomes that much more important when you reconcile. And let's say you've done at least once a month, if not on a weekly basis, then there are many different, I would say, outcomes or benefits that you as a business owner would start to notice. The simple things such as the accounting system being up to date is number one. Number two is the confidence level of your firm and yourself as if you're a sole practitioner to be audit ready. There's no more fear factor of what's going to happen that day. I'm not prepared for this because I haven't done it. So that's going away because you are ready. And in fact, you would welcome being audited because, you want to show off how well you've kept your books. And the third important aspect that often is overlooked is the readiness for compliance with the Canadian Revenue Agency. So as a business owner, you have another responsibility of showcasing, or through documents, of course, telling the story around your revenue and expense, or rather your profit and loss as a business, so that your corporate taxes, if you are incorporated, or taxes in general for your business is taken care of, because that's something that's expected by the CRA when you start a business. Whether it's a sole practitioner business, incorporated business, you do have to reflect and pay taxes if you do have a profit, right? Now, when you reconcile, especially your trust and general account, more so your general account as well, because often we see law firms are very prudent about trust reconciliations, not so much about general reconciliations. One of the biggest advantages that you have once you have a reconciled general account for that time period is the confidence in the authenticity of the numbers at the end of that month. And that number pretty much relates to your profit and loss. So if I'm confusing you, a simple example is, let's say you received $1,000 revenue. You've done a trust transfer from the trust account into the general account. And now you've had maybe a $600 expense. You've just purchased a laptop the same month. Now, if you've not entered that $600 expense, okay, the bank would, of course, automatically reflect the $1,000 and the minus $600, leaving the $400 as, say, the overall profit. But if you've not done your math and you've not reconciled, and that $600, for example, has not yet been reflected in your books, you're going to assume that that $1,000 that came in, that was the only revenue, there was no expense, and hence your profit you're assuming for that month to be $1,000. But it's not the case. The reverse is actually even worse, because you may have gotten a lot of checks and you may have forgotten, let's say, to deposit these checks. So your bookkeeping system may actually show you that you have close to $4,000 worth of revenue, but the bank is not showing that. And hence, if you don't reconcile and you're waiting till the end of, let's say, the next time period to catch all this, your month of October, for example, has not been reconciled properly because these checks now reflect only November. So, long story short, capturing transactions in your record-keeping system is one good first step, but reconciling these transactions at the end of a convenient time period, at a minimum once a month, is going to help you pretty much consolidate or validate or make it authentic for the revenue expense, which converts into P&L. The fourth and the most important thing that we believe that really helps is once you've reconciled, as part of your bookkeeping compliance requirements, the law societies within Canada expect you to generate certain documents. And we've done this in our previous webinars where we talk about your ledgers, your journals, and other jurisdictional documents. If you've done this one little step, this one little additional step of reconciling, then generating these reports is just as easy as generating a document because the numbers have been validated. And the story is very cohesive. You know that $100,000 came in, $600 left. You know that there's only $400. Now, just reflecting it in the ledger is just going to tell you a story about the date. What was it for? $1,000 came in, $600 left. But the truth of the $400 remaining, that's the crux of the whole reconciliation process. And of course, you do have the peace of mind. And from an audit perspective, as I mentioned earlier, you have your trust and general ledgers, you have your receipt and disbursement journals, and other documents such as Form 9A and B-books, expense book. What do these documents contain? They just contain the truth behind the financial transactions that have occurred in that date range. And additional details around that financial transaction, such as when did it happen, how much was the amount, what was the tax component of that financial transaction, how was it paid, who paid that, etc. Right? So that's the devil is in the details. So there's a lot of details in these documents, but the crux of the numbers comes from that reconciliation process. Okay. So before I quickly move along to a demonstration of this reconciliation process, I'd like to maybe take a brief pause to see if you have any additional questions so far. So please do use the chat window to ask me any of those questions. I'm going to just maybe spend 2 to 3 minutes on this final wrapper of a checklist. And this really relates to the soup to nuts of dealing with a client and the financial transactions that relate to that client. So I'll take a quick pause. I want to make this a little bit more engaging. If you have any questions, I'll pause right here for everything that we've covered in the last 8 slides. Once again, today's webinar is accredited for 1 hour of professionalism CPD credits in the provinces of Ontario, British Columbia, and New Brunswick. So everyone who's joined us from these jurisdictions and others, welcome. Of course, if you are part of these 3 provinces, please do use your Law Society portal or website login, and the topic is Trust and General Reconciliation Demystified. And we spoke about the whole reconciliation process, the difference between trust and general, the different components and the data points that you need to keep in mind. And the importance of the reconciliation process and what it means to be ready for these reconciliation steps. Now, one quick question that I do have is, if you already have a business, how far back can we bring the older files in? That's a great question. So typically, if these are active files, you can actually go back as old as you like. So in uLaw and many other legal accounting systems such as uLaw, the option of backdate is very much available. But it also comes down to convenience. Now at the end of this calendar year, if we typically recommend bringing active files, you can always bring files from 2015, 2016, but a good thumb of rule is to always start from the closest fiscal month or starting brand new in that calendar year. That being said, you can actually go and you can backdate these as old as you can, as long as you're prepared to enter the data that further happened after that. Okay, so if there are any more questions, then I'll just focus a minute on this particular slide. And the reason for this checklist is the compliance and the discipline that comes with the reconciliation process starts way ahead in how you plan and prepare yourself to run your business, ask for revenue, ensure that your trust and general reconciliations, or rather bank accounts, are very much in place. And this checklist starts with ensuring, first and foremost, you have a proper fee structure and a process for handling the retainers. Of course, the concept of trust and retainer, we believe, is a great asset for legal practitioners, simply because of the fact that you can now work with confidence by making that advance payment and, of course, being very responsible of how you move that money from trust to general. But you certainly have that leap of faith that at the end of the work, you're not waiting for your client to make that payment. We've seen many situations where legal practitioners spend the time and effort, disbursements many times, so paying out of your pocket to conduct and walk through that file, only to realize at the end of that file that the client has made a non-payment or cannot pay you for the service. So utilizing that retainer, that trust vehicle as we call them, is an added advantage and an asset to your overall business. And in doing so, there are certain rules, regulations, and responsibilities that you have that you need to take care of. So ensuring that there is a proper retainer agreement that you've signed, ensuring that you have followed the billing cycle and the disbursement cycle as part of the invoice based on what was agreed on that retainer. Finding a way, of course, to capture those dockets and the related revenue, the disbursements and the related recoverable expenses, invoicing the client so that you can now free up that money, which is your eligible trust money, transferring it from the trust to general. And as all these transactions happen, making sure that you are responsible for recording them in the specific accounts in which they have reflected, so that they're very much ready for prime time when time comes to reconcile. Okay? Another checklist to keep in mind, of course, is your invoice balance. And this reflects reconciliations. And that's why we brought this here. An invoice balance report, as you probably better know, is a document that pretty much outlines outstanding trust transfers or eligible trust transfers from trust to general and outstanding payments that you should expect from your clients. So let's say you've done everything right. You've done the trust transfers, or rather you've got the retainer, you've done the work, you've invoiced, but you have now failed to do that trust transfer from the trust to general. then that eligible trust amount is just sitting in your trust account and you have failed to generate and recognize that revenue for the time period. So generating invoice balance on a weekly basis gives you a fail-proof checklist of all the transactions and the money that you need to move and any outstanding payments that you should phone your client and ask for. Okay? And as we are talking about this, making sure that you have the right process and system to handle the required procedures and documents around trust and your general account. And the last aspect to this is, of course, this would be phenomenal if all of this was automated, but the reality of life is that it's not yet there. Not sure it would completely be automated at any time. So there is a certain level of manual intervention that is importantly required. Because sometimes if you've not entered and recorded these transactions, then the authenticity and the details of those transactions are very much in your own brain. And hence, if you're able to do it more frequently, as I mentioned earlier, your memory is fresh, you're clearing your plate, and you can easily appreciate what these transactions meant to begin with. But from a reconciliation standpoint, typically we see law firms spend, if you're doing this on a manual basis, then you're of course going to be spending a lot of time and effort. If you are using, and that's what we recommend, that you make an informed decision to acquire or purchase a software that can help automate some of the manual tasks that can be automated. So recording a retainer can automatically relate to being available in the trust ledger, such as a legal accounting system. So there is no single product that we would recommend, even though we're talking about it from a uLaw perspective. We want you as the client, as the consumer in this case, to have the power to do the homework, choose a product that best suits your firm's style based on the transactions, based on many factors, cost. And if you're doing this manually, our only recommendation is that you explore the use of software and get familiar with it, invest the upfront time that it takes to learn the software, take the leap of faith by putting the data in, and help yourself reduce the amount of time that it takes to manage all of this. Okay. And you can Google this. There are quite a few reference documents that talk about audit readiness, whether that's a checklist or a spot audit, frequently asked questions. Of course, we've continued to use these slides because they've been accredited, and hence you see these outdated links. But if you can just say spot audit LSO, or you can go spot audit BC, spot audit NB, you are able to provide and get these documents as well. Okay? All right. So with another 10 to 12 minutes left in today's webinar, I'm going to quickly shift gears from a presentation mode into my fictitious uLaw account for my friend Roger Moore. Okay, so let's start with, yes, the question is, can we start general account first and then continue to add trust? Absolutely, yes. In fact, many of the businesses that start off first have more general transactions, both from a client-related as well as a office expenses related, right? So many of the work that's entered into the legal accounting system could be related to expenses, for example. Okay. So let's go through this quick process. I'm going to draw your attention to the reconciliation document. So let me first show you my trust reconciliation. I'm going to choose the trust reconciliation, and you can see as of today's date, there are no transactions. Okay, so assuming that nothing has come in, nothing has left the trust. Of course, I have done some homework here to reconcile till date, but as of today, let's say there's a blank slate. Now, a client walks in, and let's quickly add that client information as part of our client. So for purposes of time, I'm just going to go ahead and click Save as Matter, but assuming you have an address, a phone number, and as much as detailed as possible for Doogie Howser. Not sure if I'm the only person who can appreciate Doogie Howser. Maybe I'm the only old guy here, but it used to be one of those very famous sitcoms when binge watching was not a really big deal. This was in the early 90s probably. Pretty much an early version of Good Doctor. Nevertheless, so let's say we have Doogie Howser as the client. I'm going to go ahead and I've clicked on Matter, so it's going to open up a brand new Matter page. You open the file. Again, I'm going to assume you've done the retainer agreements. And let's say you receive what's a good number? Let's say $1,000 plus tax, $1,130, and maybe another $200 for disbursements. So I'm going to say and this is relevant whether it's a real estate transaction, whether it's, it really does not come down to how much money is involved. It really does come down to the process in handling that money. So you're now documenting or recording, as we call it, that you received $1,330. Maybe you asked for a retainer payment, so now you're recording that new retainer came in today. So $1,130 or $330. And again, you could have been paid in many different ways. Let's just say this was a email transfer, a transaction number, telling your system the actual real-life financial bank account that this was entered into, giving a receipt, so a retainer receipt, highly recommended. So that was $1,330 that you've entered into this matter that you've received it. Now, of course, if you've just got that, if it's an email transfer, the chances are that your bank would reflect the deposit today. But if you look at it from a reconciliation standpoint, if I go back to the trust reconciliation, before we had an empty slate, but now you see automatically the legal accounting software takes that recorded information in the matter and relays it as part of your reconciliation preparedness. So it tells you that as of 6th, there's $1,330 deposited into trust account. Okay? And in terms of backdating information, of course, you can have backdated this as well. So you can go ahead and edit this transaction. And let me say instead of today, I received this yesterday. Okay. All right, so I'm going to quickly run through this so that I can show you the reconciliation process rather than the transactions. So I'm going to say one flat rate and make this a flat rate of $1,000. Again, keep in mind this could be anything, and it really comes down to your retainer agreement of how you docket, disperse, and invoice this client. You've got, and I'm going to say, instead of a trust, I'm going to do a general transaction. And say there's a court fee paid for the client, and this is paid to the Ministry of Finance through a check. I could even potentially print that check, but I'm going to skip that. So now you've got $1,000 worth of work, $130 worth of taxes that you should receive, and then $200 worth of disbursements that you should recover. Let me go ahead and invoice. This is the next important step, and we do this in a law firm day in and day out, right? The docketing, dispersing, invoicing. 3 important steps that's done every single day. Now we looked at one of the checklist documents, which is the invoice balance. Let's say you've done all of that good work, and now you have forgotten to transfer that $1,130. So technically you've earned the $1,130. So the invoice balance as a document would allow you to reflect who owes you what money in what form, and if you have to do any trust transfers yourself. Okay? I probably should have created the document. And here's the invoice that clearly reflects that as well. Again, so far you've done everything right. I'm going to just skip through that process real quick. If you can just bear with me for a second. All right, so let me jump back to that matter. And do that trust transfer. Until you do that trust transfer, just so you understand, the trust reconciliation should not reflect any money leaving the trust account. Okay, so it's still $1,330. Now when I do the trust transfer, I'm transferring the eligible amount of $1,330 from trust to general. I'm just going to write myself a check. Now this is a financial transaction that has occurred. And now if I move into my trust reconciliation, I realized that the $1,330 that was deposited, and now through the trust transfer, $1,330 has been withdrawn. And let's say you're doing a trust reconciliation report for today or at the end of this week. You would open up your bank statement and you would check if this transaction existed. Maybe this retainer was only reflected on the 6th. So the 5th is when you reported it. Maybe it was only on the 6th. And then you validate if this transaction exists between the bank and your bookkeeping system. Choose the date. So of course you're going to choose the 6th. This is where you're going to now enter your bank balance as of the 6th. And now, when the transactions match and when your bank balances match, which is the total account balance and your unexpended balances for your bookkeeping system's ledger, you're good to generate the trust reconciliation report. So one, to be able to convert the record keeping of your transactions into reconciliation transactions. Second is to compare those reconciliation transactions with your financial institution based on a date, catch any errors or mistakes that may have happened during that time period, and then generate that report, whether that's a monthly basis or weekly basis. Same thing happens for your general reconciliation. So that $1,130 that was moved from the trust to general, that's a transaction. And that has been now recorded in your general account as a deposit because you moved the money from trust to general. And you do the same thing. You'd clear these transactions one at a time. And if you have any mistakes, if you have to clarify something, and if you see there are additional transactions in the bank, then you would go back into the system, add a retainer or a payment like how we did, and you would see that it would automatically reflect here. And you would enter the bank balance and generate your general reconciliation. So here's the trust reconciliation report that tells you the closing balance as per the bank, any outstanding withdrawals or payments. Now step 3, if you remember, was the client's trust listing. And of course this is a playground account that I'm using, and hence you have really old clients with trust balances, which again we indicate to you in brown or red, indicating that you probably should return this retainer if you've not used it for this long. And that's the reason for the last activity date. Okay? And finally, you have your trust comparison as of this date between the bank and your own ledger. And you do the same thing for the general account. And this is the general reconciliation, closing per bank statement, any outstanding withdrawals or payments, and the final comparison between the bank and the ledger. Okay? And once you've done this, generating your trust ledger or your general ledger is very straightforward, because you know for a fact that you've confirmed $1,130 was deposited on the 5th, $1,130 left the bank on the 6th, so there's no confusions there. That's your trust ledger, and you can do the same thing for your general ledger. So for Doogie Howser now, That's the $12,330 that you received on the November 5th. And the court fee of $226, transferring the $1,330 over, leaving your trust balance at zero. So once you have reconciled, generating these Law Society compliant documents such as ledgers and journals becomes a very easy process. So for Mr. Doug, you have the 1,130, the 226, and as you can see, there's still a payment of $26 that's remaining to be accepted. Okay? As we come to the end of this webinar, of course, I wanted to highlight the importance of the trust and general reconciliation process in your legal. Please do email us if you have any specific questions regarding today's webinar or additional questions regarding trust and general reconciliations. We are a Canadian company based out of Ottawa. We offer legal accounting, practice management, and business accounting software. Please do check us out at uLawPractice.com. And I will thank you for joining me in today's webinar, and we look forward to seeing you in our webinar next Friday.